So welcome back for, I think it's the last time, if I've counted correctly, to managerial accounting. And the purpose of this little mini lecture is to review the take-home part of the exam number 3. And the first question you had there, remember this builds upon the first 32 are multiple choice, so 33, 37 are the take-home part of the exam. And you're given information about a company that manufactures ketchup, and you're asked to do two things. In part A, you got to determine the standard unit material cost per pound of the standard batch. And part B, you've got to determine the direct material quantity variance for this particular batch. So to get the standard cost per pound, you have to use the standard quantity for the various ingredients: whole tomatoes, vinegar, corn syrup, and salt. You got to multiply each standard quantity times the standard price. So here's your standard cost per batch. And if you add up all those costs, you get $4,590. And a batch, typical batch, is 7,650 pounds. So the cost per pound is 60 cents per pound. There's your cost per pound. And then B, you got to determine the direct materials quantity variance for this particular batch. So to get the quantity variance, you got to take the actual quantity of the ingredients used, subtract out the standard quantity of what they were supposed to use. And what you see here is you had a favorable volume variance with regard to whole tomatoes and a favorable one with regard to corn syrup, favorable in that they used less than they were supposed to use. Okay, the actual quantity is less than the standard quantity. And then you were more in the vinegar and in the salt. So you multiply the variance times the standard price, and here is your quantity variance. And again, you've got whole tomatoes, which is a positive variance, and you've got our favorable variance, and you've got corn syrup, which is a favorable variance. And so if you net these all out, you actually get a quantity variance, which is a favorable quantity variance of $55.50. Okay, that was the first question. And the next one, you had to compute labor variances here. So they gave us the information on the standard quantity of direct labor used, the actual rate that was paid, the bicycles that were completed each month, the standard direct material labor, the direct labor per bicycle, which is supposed to be 5 hours, and the standard rate for the direct labor, which is supposed to be $30 per hour. And on the basis of that, we had to compute the direct labor rate variance and the direct labor time variance. So the rate variance would be the actual rate that they paid, which was $32 an hour, minus the standard rate, which they were supposed to pay, which is 30, multiplied by the actual number of hours that they worked. And the actual number of hours that they worked, quantity of labors actually used, was 2,600. So you get a unfavorable rate variance of 5,250. And then as far as the time variance, they worked, it's supposed to be actual direct labor hours minus standard hours for standard direct labor hours. And they made 500 bicycles, and each bicycle was supposed to take 5 hours. So it's supposed to be 5 times 500 gives you 2,500. So the direct labor time variance would be the actual hours, 2,600, minus the hours that they should have worked, which was 2,500, multiplied by the standard rate per hour, not what they actually paid, but what it was supposed to be, which was 30. And then you get an unfavorable variance of $3,000. So you get unfavorable time variance of 3,000. You get an unfavorable rate variance of 5,250. You add those together and you get $8,200 unfavorable variance. And then B, how much direct labor would be debited to work in process? So the labor that would be debited to work in process, as they're using a standard costing system, would be the standard hours for actual production times the standard rate. So they made standard hours for actual production. They made 500 bikes. Each bike was supposed to take 5 hours, so that's 2,500 hours. And the standard rate they were supposed to pay was $30 per hour. So it should have been a debit to work in process of $75,000. 35 had to do with the DuPont formula. So they give us information about this company, Strangelove division of the Megadeth industry, And on this basis, you're supposed to figure out, using the DuPont formula, determine the profit margin, the investment turnover, and the return on investment, assuming that 106 million of assets have been invested. Okay, so the ROI is the profit margin times the investment turnover. Profit margin is operating income divided by sales, and you would multiply that by the investment turnover, which is sales divided by investment assets. So operating income was 42,400,000. Sales were 265 million. Okay, so that multiplies out to 16%. And then the sales divided by investment is 265 million divided by investment of 106 million, which is 2.5. So you have a 40% ROI. And then what happens in B, if you went ahead and you cut expenses somehow by 5,300,000 without affecting sales, then your operating profit is not 42,400. If you can figure out how to have 42,400,000 extra zero in there, if you can figure out how to reduce expenses by 5,300,000, that's going to increase your operating profit to 47,700,000. Divide that by sales. Okay, so that now goes from 16% to 18%. You didn't change the investment turnover, so your profit margin is now 45%. Okay, so the net effect of reducing the expenses there is to increase the profit margin from 16 to 18%. The investment turnover doesn't change, but the ROI now becomes 45%. 36, you've got alternatives. You can continue with the old machine, or you can replace the machine. And what they asked us to do in Part A was prepare a differential analysis between alternative number 1, which is continue with the old machine, and alternative number 2, replace the old machine. And then Part B, they say, should you replace the old machine? Okay, so what you need to do is you need to contrast the revenues and the expenses, continue with the old, replace the old machine. So there's no impact for over the 6 years on the revenues remain the same. As far as cost, if you replace the old machine, you get a cost there of purchasing the machine you'd replace it with. So that reduces profits by 500,000. So differential analysis is we put parentheses around it to indicate it's a reduction. Direct materials would be the same under both. It's 6 years, so you have to take the direct materials 120,000 multiplied by 6. Direct labor, under direct labor, well, under the if you continue with the old machine, direct labor there is $90,000 a year. $90,000 a year times 6 is 540,000. If you replace the old machine, you wouldn't have any direct labor costs. So the differential analysis is actually plus 540,000 there. If you replace the old machine, you're going to reduce labor by 540,000. Power and maintenance, you had 9,000 under the present operations. 9,000 times 6 is 54,000. And then it's 26,000 for the replacing the old machine. So 26,000 times 6 gives us 156,000. So replacing the old machine is going to reduce profits by 102,000. Taxes, insurance, etc., had been 1,000. Under the old machine, 1,000 times 6 gives us 6,000. With the new machine, it's now 4,000. So 4,000 times 6 gives us 24,000. So the delta there is $18,000 reduction as a result of replacing the old machine. Selling and administrative expenses are the same under both. So what you have there, if you continue with the old machine, you get a profit of 780. If you replace the old machine, you get a profit of 700,000. So replacing the old machine reduces profits by 80,000. So on that basis, you should reject the proposal to replace the old machine because it would reduce profits by 80,000. And the last one is a net present value one. It kind of gave you a hint in class of what you needed to do. Looks like all of you got this correct. So first of all, you had to figure out the revenues. So they told us that capacity was 3,600. They told us what that we would sail for 340 days. They told us that the average sales average rate per cruise per day is 280. So there is your annual revenue. The variable cost they told us was $100 a day. So 3,600 times 340 days times $100 a day. And then the fixed, not fixes, it's fixed expenses other than depreciation, they told us was $90 million per year. So the annual cash flow is $1,320,000. So there's your annual cash flow. And now you have to get the present value. So the key to the present value here is to know that it's for 10 periods and the interest rate is 12%. So you have to get the annuity income, which is 130,320,000. Go to the annuity table, and if you go N is equal to 10 and I is equal to 12%, you get 5.650. So there is the present value of the annual income. And you also have to consider the present value of the salvage value of the machine. This is not an annuity. This is one payment that you get at the end of 10 years multiplied by 12%. So you use a different table. And the multiple there is 0.322. Here's the actual amount invested, 750 million. So your net present value is 5,628,000. Okay, so I've said this before. I've enjoyed having you as a class. I wish you a great summer, and I wish you all the best in your future career and your future studies. Be well, everybody. Au revoir. Hasta luego. Work hard, study hard, play hard. Enjoy your summer. Bye-bye, everybody.